9 things change about your money between now and next January, and every single one of them already has a date attached to it. These are not proposals. Nobody has to vote on them. Nothing here depends on an election or a court or a deal getting done. The dates are already set and the calendar is already moving. And here is what struck me when I laid all 9 on one page in front of me. The order of the dates runs almost exactly backward to the order of the attention. The one you will hear about the most, the number that gets announced in October with headlines on every channel, will be largely gone before it ever reaches your bank account, and I will show you that arithmetic in about 4 minutes. The one almost nobody will mention has a window that opens on the 15th of October and closes on the 7th of December, and for a great many of you it is worth more, in actual dollars, than the first one by a wide margin. And the 9th one is not being covered anywhere at all. It can take 15% of your monthly check. It reaches about 452,000 people, and it is not starting next year. It is restarting right now. So this is not a video about what might happen. It is a calendar. 9 dates, in order, with the specific move attached to each one. Let me say something about the shape of this before we start, because it will help you hear the rest of it correctly. Some of these 9 are simply arithmetic. A number goes up, another number goes up, and what actually lands in your account is the difference between them. Those are not anybody's decision. They are formulas running on schedule. Some of them are deadlines. A window opens, a window closes, and if you did nothing during it, the consequence lands in January and you carry it for 12 months. And 2 of them are enforcement. Something that was paused starts again, or something that was voluntary becomes required. Those 3 kinds behave completely differently, and people treat them all the same, which is how a person ends up worrying constantly about the arithmetic they cannot change and missing the deadline they could have used. My name is Kevin. I read the boring documents so you do not have to sit with them, and every week I bring one of these here in plain English with the actual action attached. If that is useful to you, subscribe and turn the bell on, because the 4th item in this video has a deadline sitting inside the next 8 weeks, and it is the single highest value thing anybody watching can do this autumn. So, the first date, the 14th of October. That is when the cost of living adjustment gets announced, and it decides what your check says starting in January. Here is how the number is actually produced, because almost nobody explains this and it matters. It is not a decision. Nobody sits in a room and chooses it. It is a comparison between the average of one particular inflation index across July, August, and September of this year against the same 3 months of last year. That index is called the Consumer Price Index for Urban Wage Earners and Clerical Workers. Notice the name. Urban wage earners and clerical workers, working people. That is who the basket of goods in that index was built around, which is the oldest complaint about this entire mechanism, and it is a fair one. The spending pattern of somebody who is working looks very different from the spending pattern of somebody who is 78. Housing and medical care are a far larger share of an older household's spending and a smaller share of that index. There is a different index that was designed specifically for people 62 and older. It exists. It has been calculated experimentally for decades. It is not the one used. So when your increase feels smaller than your actual costs went up, that is not you imagining things, and it is not bad luck. It is a measurement question, and it is a real one that serious people on both sides have argued about for years. Now, where the estimates currently sit. The Senior Citizens League is predicting about 3.6%. Other trackers using the same data through July are landing closer to 3.1%. Some earlier projections had it near 2.8, which is what last year came in at. So the honest range is somewhere between roughly 2.8 and 3.8%. And anybody telling you they know the exact figure today is guessing, because the September data is not in yet. There is one more thing about the timing worth knowing, because people get confused by it every year. The adjustment is technically effective for December, but it shows up in the payment you receive in January. Supplemental Security Income recipients see it slightly earlier, at the very end of December, because those payments arrive on the 1st of the month, and the 1st of January is a holiday. So if you are on both, and a great many people are, you will see one change before the other, and nothing has gone wrong. And you will get a notice about it. In late November, the adjustment notice goes into the message center of your online account for most people, and by post for everybody else. That notice is worth actually opening because it states your new payment amount directly rather than making you calculate it, which is genuinely the easiest way to get the real figure. Not the headline percentage in October, not your own multiplication. the letter in late November that simply tells you the number. Here is what I want you to do with any of those numbers, and it is one sentence. Whatever the announcement says, that is not your raise. And I want to say why that sentence matters more this year than usual. When the adjustment is small, everybody notices that it is small and adjusts their expectations accordingly. When the adjustment looks reasonably healthy, and something in the range being predicted would look reasonably healthy, people plan around it. They think about a repair they have been postponing, or a bill they could finally get ahead of. That is the year the gap does the most damage. Not because the gap is bigger, but because the expectation was. Delphia is 73, and she has the same reaction every single January, and she described it to me better than I could. She watches the announcement in October. She writes the percentage on the calendar in the kitchen. She works out what it should mean for her, which last year came to about $58 a month. And she allows herself to plan around it a little. Not extravagantly. She had in mind that the $58 would cover the increase in her supplemental insurance and leave a bit over. Then January arrived, and the actual difference in the deposit was under $30. Nobody had lied to her. She had simply been told the first number and not the second one, and the second one is the one that reaches the account. And she said, the thing that I think a great many of you will recognize. She said, the disappointment is worse than if they had never announced it at all. That gap between the number in the headline and the number in the account is exactly what the quiet rules is built to close. Not clever strategy, the plain arithmetic of what actually lands, written large enough to read without hunting for your glasses, so that you plan around the real figure in October instead of finding out the real figure in January when you have already spent it in your head. Working it out beforehand takes one quiet afternoon. Finding out afterward costs you the whole winter. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on your television right now, there is a code on the screen you can point your phone camera at. 7-day guarantee, always, no argument. If it does not put something in your hands you did not already have, send it back. Which brings us straight to the second date, because this is the other half of Delphia's arithmetic. Sometime in November, the Medicare Part B premium for next year gets announced, and that premium comes directly out of your Social Security payment before it is deposited. This year, the standard premium is $202.90 a month. Projections for next year put it somewhere around $213, which would be an increase of roughly 5%. Now watch what that does. Take somebody with a benefit of $2,000. A 3% increase is $60. The Part B increase is about $10, so the actual change in the deposit is about $50, not $60. That is not a scandal, and nobody is stealing from you. Part B is a premium for medical insurance, and it has always been deducted this way. But it means the headline percentage and the deposit almost never agree, and the smaller your benefit, the harder that bites, because the premium is a flat dollar amount that does not scale down for people with less. Somebody with a benefit of $900 gets the same $10 premium increase as somebody with a benefit of $4,000. On the smaller check, that eats a far larger share of the raise, so the practical instruction is short. When the October number comes out, do not do the multiplication. Wait until November, take the premium increase off, and then do it. That is your actual figure, and it will be the one that shows up. There is one protection worth knowing about here, and it does not apply to everybody. There is a provision that generally prevents your Part B premium increase from being larger than your dollar increase from the adjustment, so that your net payment does not go down year over year. It has exceptions, and it does not apply to everyone, but in years when the premium rises faster than the adjustment, it is what stops a great many people from actually losing ground in cash terms. There is a second thing about Part B that catches people every year, and it has nothing to do with the standard premium. If your income is above a certain level, you pay more than the standard amount. That surcharge is called the income-related monthly adjustment amount, and it is calculated using your tax return from 2 years earlier. 2 years earlier. So the premium you pay next year is based on what your income looked like 2 tax years ago, which produces a genuinely unfair situation that happens constantly. Somebody sells a house, or takes a large withdrawal from a retirement account, or receives a one-time payment. 2 years later, long after that money is spent, a surcharge arrives based on an income they no longer have. And here is the part people do not know. There is a form for exactly this. If you have had a qualifying life-changing event, and that list includes retirement or reduced work hours, the death of a spouse, divorce, and several others, you can ask for the surcharge to be recalculated using your current income instead of the 2-year-old figure. People pay that surcharge for a full year without ever knowing the form exists. If your income dropped for one of those reasons and you are paying a surcharge, that is worth a phone call this month. Now the third date, and this is the one I told you at the start, is worth more than the first two for a lot of you. The 15th of October to the 7th of December. That is the Medicare annual enrollment period. During those 8 weeks, you can change your Medicare Advantage plan, change or add a prescription drug plan, or move between Advantage and Original Medicare. Whatever you choose takes effect on the 1st of January. Here is why this window is worth more than the adjustment. The adjustment is a fixed formula. You cannot change it by a single dollar no matter what you do. It is arithmetic happening to you. This window is the opposite. It is 8 weeks in which your decisions actually change what you pay for the next 12 months, and the differences involved are frequently in the hundreds or thousands rather than the tens. And the reason it matters more some years than others is that your plan does not stay the same. Advantage plans and drug plans are 1-year contracts. On the 31st of December, your plan as it currently exists ends. What arrives on the 1st of January is a new one, often with the same name and the same card and different terms underneath. Which is why the single most important piece of mail you will receive this autumn is a document called the Annual Notice of Change. Your plan is required to send it before this window opens. It tells you exactly what is changing about your specific plan for next year. The premium, the deductible, what you pay for a hospital stay, which drugs are still on the list, which doctors are still in the network. Almost nobody reads it because it arrives looking like every other envelope from an insurance company, and there is nothing on the outside saying that this one determines what a hospital night cost you next year. So here is what to do, and it takes about 20 minutes. Find that notice. Go to the section listing what changes. Check 4 things specifically. Is my prescription still covered, and at what tier? Is my doctor still in network? What is my out-of-pocket maximum next year compared to this year? And what does an inpatient hospital day cost now? If any of those moved in a direction you do not like, this window is when you can do something about it. And after the 7th of December, you generally cannot until the following year. And there is free help for this that almost nobody uses. Every state has a health insurance assistance program, funded federally, staffed by trained counselors who do not sell anything and do not earn a commission. They will sit with you and compare your options against your actual medication list. It costs nothing. It is not a sales call. And in most states, the appointments fill up in November, which is why the useful move is to ring them in October. 2 more things about that window, because they are what separate a useful 20 minutes from a wasted one. The first is the mistake nearly everybody makes, which is comparing plans on the monthly premium. The premium is the most visible number, and it is very often the least important one. A plan with a lower premium and a higher hospital day rate, or a worse drug tier for the one medication you actually take, costs more over a year than the plan you left. Compare on your own medication list and your own doctor's, not on the headline price. The second is that if you take prescriptions, bring the actual bottles or a written list with the exact dosages when you compare. Not the general name of the drug, the specific one with the strength. Drug lists are built at that level of detail, and a plan that covers your medication at 1 dose can treat a different dose entirely differently. And one thing worth knowing if you have an Advantage plan, there is a second window from the 1st of January to the 31st of March in which you can switch Advantage plans once or return to Original Medicare. So if January arrives and something is badly wrong with the plan you have, that is not the end of it. But it is narrower than the autumn window, and it does not apply to everybody, so it is a safety net rather than a plan. The 4th date is the 1st of January, and this one is a number moving in a direction that surprises people. The cap on what you pay out of pocket for prescription drugs under Part D is going up. This year, the cap is $2,100. Next year, it becomes $2,400. Read that carefully because it is the opposite of how a cap increase usually sounds. This is not more protection. It is the ceiling moving further away. It means you have to spend $300 more of your own money before the point where your plan starts covering everything. For most people, that changes nothing at all because most people never approach the cap. But for somebody on an expensive medication, that is $300 additional out of pocket, arriving in the early months of the year at exactly the time of year when heating bills are highest. The cap is still an enormous improvement on what came before it, which was no ceiling at all. But it adjusts upward every year, and the direction of that adjustment is worth understanding, rather than being surprised by in March. And if that $300 matters to your household, that is the strongest possible reason to look at the program called Extra Help, which is a separate federal subsidy that can cover your premium, wipe out your deductible, and cut your copays down to a few dollars. It has income and resource limits. They are more generous than nearly everybody assumes, and your home and your car do not count toward them. The fifth date is also January, and this one only touches you if you are still working. The maximum amount of earnings subject to Social Security tax goes up. This year it is $184,500. The trustees projected at $190,200 next year. In practical terms, an additional $5,700 of earnings becomes taxable, which for somebody earning above that line is roughly $353 more in payroll tax over the year, with the employer paying the same again. If you earn below that cap, and the overwhelming majority of people do, nothing about this changes anything for you. You were already paying on every dollar. I include it because this is the number at the center of the entire national argument about how to fix the program, and it is worth knowing what it actually is, rather than what people say it is. The sixth date is January as well, and this one matters if you are drawing benefits and still working, which is a larger group than people think. There is an earnings test. If you are under full retirement age for the whole year and you earn above a certain amount, benefits get withheld, $1 for every $2 over the line. This year, that line is $24,480. In the calendar year you actually reach full retirement age, the rules loosen considerably. The line jumps to $65,160 this year, projected at around $67,200 next year, and the withholding drops to $1 for every 3 over. And from the month you reach full retirement age onward, the earnings test disappears entirely. You can earn any amount at all with no effect on your benefit. Now, here are the two things about this that people get badly wrong, and both of them cost real money. The first is that money withheld under the earnings test is not gone. It is not a penalty, and it is not confiscated. When you reach full retirement age, your benefit is recalculated upward to account for the months that were withheld. You get it back, spread across the rest of your life. A great many people believe they lost it permanently and made an entirely different decision about working because of that belief. The second is that in your first year of claiming, there is a monthly test as well as an annual one. So somebody who earned a great deal in the first half of the year, then retired, can often still receive benefits for the remaining months based on their monthly earnings, regardless of what the annual total says. People assume they have to wait until January and lose several months of payments they were entitled to. There is a third piece of this worth knowing, and it applies to people who have not claimed yet. The earnings test only exists before full retirement age. So the decision about working and the decision about when to claim are connected in a way people miss. Somebody who intends to keep working substantially and who has not yet reached full retirement age may find that claiming early produces very little actual income because the earnings test withholds much of it while permanently reducing the benefit amount. That combination is genuinely poor arithmetic, and it happens because people think of the two decisions separately. And a related point that catches surviving spouses in particular. The earnings test applies to survivor benefits as well. Somebody widowed at 62 who is still working full-time and claims survivor benefits may see most of those payments withheld when waiting would have preserved them entirely. None of that means do not claim. It means the earnings test belongs in the calculation, and for a great many people, nobody ever put it there. Clovis is 64, and he turned down a part-time job last spring because of exactly that first misunderstanding. It was 20 hours a week at a hardware store, work he would have enjoyed with people he knew. He had heard from somebody at church that if you go over the limit, Social Security takes the money and you never see it again. So he did the arithmetic on losing benefits permanently and concluded it was not worth it, and he stayed home. He was working from a fact that was wrong, not a small detail, the central fact of the decision. And the thing about it that bothers me is that the correct information would have taken 1 page and 4 minutes to read, and instead, it cost him a year of work he wanted, income he needed, and something harder to price, which is somewhere to go on a Tuesday. That is what the guide is for, not complicated strategy. The handful of things that are simply not true, corrected plainly in large type so that nobody makes a year-long decision out of something they overheard. The cost of not having it is not abstract. For Clovis, it was roughly $15,000 of work he turned down for no reason at all. Same place, kevinexplains.shop. The link is in the description and in the pinned comment, and the code is on your screen if you are watching on the television. 7-day guarantee every single time. A man of 64 sitting at home for a year because of something somebody told him after a church service. Now the 7th date, and this one is the largest change on the whole list in terms of how many people it reaches. The 1st of January, and it is a work requirement for Medicaid. Here is what it is. Adults covered through the Medicaid expansion, meaning people aged 19 to 64 who qualify on income, will be required to demonstrate 80 hours a month of qualifying activity in order to keep coverage. States must have this in place by the 1st of January. 80 hours a month works out to about 20 hours a week. It can be met by paid work, by half-time enrollment in school or technical education, by an approved job training program, by community service, or by any combination of them added together. It can also be met by earning at least a certain monthly amount, which at the federal minimum wage works out to roughly $580. This applies across 43 states and the District of Columbia, and reaches roughly 20 million people. Now, two things I want to say clearly, because this is a live political argument, and I have people watching from every position on it. First, the exemptions, because a great many people who assume this hits them are exempt. There are exemptions for caregivers of dependent children, for veterans with disabilities, for pregnant women, and for people with serious mental health or substance use conditions. Being over 65 means you are not in the expansion group at all, and this does not apply to you. Second, the argument on both sides. Supporters make the case that a work or community engagement expectation is reasonable for able-bodied adults, and that similar requirements exist in other assistance programs. Opponents point to the states that have already run this and argue that the coverage losses come overwhelmingly from paperwork failures rather than from people refusing to work, meaning the people removed are largely people who were in fact working and failed to document it correctly. Both of those are real positions held by serious people, and I am not going to tell you which to hold. What I will tell you is the practical fact, which is not political at all. Several states have already been running this. Georgia has since 2023. Nebraska began in May of this year. Montana and Arkansas began in July. Those states are the preview, and the consistent lesson from every one of them is the same. The failure mode is almost never somebody refusing to work. It is a notice going to an old address, or a reporting portal that did not accept the documentation, or somebody not knowing they had been flagged until the coverage was already gone. There is a 30-day grace period to provide proof of activity or of an exemption before coverage terminates. 30 days is not long if the notice went to the wrong house. So if this touches anybody in your family, the single most valuable thing you can do this autumn has nothing to do with work at all. It is making sure the address, the phone number, and the email on file with the state Medicaid agency are current, and that somebody in the household knows to open mail from them immediately rather than setting it aside. And there is a practical detail about proving compliance that the states already running this have made very clear. The systems are generally designed to verify your hours automatically wherever they can by checking payroll data and other records the state already holds. For somebody with a steady job at a single employer, that often works and no action is needed at all. Where it breaks is everybody else. Somebody paid in cash, somebody working several small jobs, somebody doing seasonal work, somebody caring for a parent, which is qualifying activity in many circumstances, but does not appear in any payroll system anywhere. Those are precisely the people who have to actively document and report, and precisely the people least likely to have a straightforward way of doing it. So the practical instruction for anybody in that situation is to start keeping the record now rather than in January. A simple written log of dates and hours, pay stubs kept rather than discarded, a letter from whoever you help care for, enrollment paperwork if it is school or training. It sounds excessive. It is the difference between a portal accepting your documentation in an afternoon and a 30-day clock running while you try to reconstruct 6 months of work from memory. The 8th date is the same day, and it is the quieter half of the same law. Two other things change for that same group on the 1st of January. Renewals move to every 6 months instead of every 12. That is twice as many opportunities in a year for a form to go astray, and the failure mode is identical to the one I just described. And the retroactive coverage window shortens. That is the provision that allowed coverage to reach backward to cover medical bills incurred shortly before you applied. It is being narrowed, which means the gap between getting sick and getting approved becomes a gap you may be responsible for. There is a third consequence that almost nobody has reported, and it is the one that concerns me most. Beginning on the 1st of January, somebody who loses or is denied Medicaid solely for failing to meet the work requirement will not be eligible for marketplace subsidies either. Normally, losing Medicaid is the thing that qualifies you for help buying a plan on the marketplace. In this specific circumstance, it will not. So the ordinary safety net underneath losing Medicaid does not catch this particular fall. That is a significant detail, and it is worth knowing before January rather than after. And the ninth item, which is not being covered anywhere and which is not next year, it is now. If you have a defaulted federal student loan, the government can withhold up to 15% of your monthly Social Security payment to collect it. Retirement benefits, survivor benefits, disability insurance benefits, all of them. Collections were paused for years during the pandemic, restarted, then paused again in early this year, while the Department of Education rolled out its new repayment system. That system launched on the 1st of July, and involuntary collections, including Social Security offsets, are restarting on that timeline. About 452,000 people receiving Social Security are currently in default and within reach of this. And I want you to understand who these people actually are, because the picture in most people's heads is wrong. Government analysis of older borrowers subject to this found that about 43% had held those loans for 20 years or more. 3/4 had borrowed only for their own education. Most owed less than $10,000 when the offset began. The typical monthly amount taken was a little over $140, and almost half were subject to the full 15%. And an enormous number of the rest are grandparents and parents who took out or co-signed loans for a child's education decades ago. There is a floor, and it matters. Your check cannot be reduced below $750 a month. So the amount taken is the lesser of 15%, or whatever amount would bring you down to that floor. If your entire benefit is under $750, nothing can be taken at all. And supplemental security income is fully protected and cannot be offset. Now here is the part that actually matters, because there are 3 ways out, and most people know about none of them. The first, and it is the most effective for the majority of people, is loan rehabilitation. 9 on-time monthly payments made within a 10-month period removes the default status entirely and stops the offset. The payments are based on your income, and for somebody on a modest benefit, they can be very small indeed. The second is a hardship reduction. Under federal law, the department can determine that the standard offset amount would cause hardship and reduce it. And the agencies involved have historically been more willing to grant reductions on Social Security offsets than on tax refunds. The third applies if you are receiving disability. Total and permanent disability discharge can eliminate the federal loans entirely. You are also supposed to receive a warning letter at least 30 days before an offset begins, telling you when it starts and how much. If you act inside that window, you can often stop it before it ever touches a payment. And if you are looking at a letter like that right now, or you think you might be in this category and cannot work out where you stand, email me. The address is on your screen and in the description below. I read every single one that comes in. There is one more thing here that matters enormously, and almost nobody says it, so I want to be direct about it. There is a difference between being behind on a loan and being in default. Default happens after roughly 270 days of missed payments. A loan that is late, or in forbearance, or in a repayment plan you are struggling with, is not in default, and none of this applies to it. So if you are worried, the first question is not, how much do I owe? It is, what is the actual status of the loan? And you can find that out in one place, at the Federal Student Aid website, which lists every federal loan in your name and its current status. That matters because the fear is frequently larger than the situation. People assume that being behind means the worst thing is already happening, avoid finding out, and lose the window in which it was easy to fix. And if the loan genuinely is in default, the new repayment plan that launched in July calculates payments as a percentage of income with a minimum of $10 a month. For somebody living on a modest benefit, the payments involved in rehabilitation may be far smaller than anything they have imagined. Reba is 68 and she signed for her son's loans in 1996. He finished the degree. Life went in the direction lives go. The loans came back to her, and by the time she understood that they had, she was not working anymore, and the balance had grown in the way these balances grow. What she said to me was not about the money. She said that for 11 years she has been afraid to open certain envelopes, and that she has a drawer, and that she knows exactly which drawer it is and how full it is. The offset had not even started when she wrote to me. The fear had been running for a decade on its own. And rehabilitation, 9 payments based on what she can actually afford, would end the entire thing. It has been available the whole time. Now let me tell you what is not changing, because a fair amount of what circulates online about next year is simply false, and you deserve the correction. Full retirement age is not going up. It is 67 for everybody born in 1960 or later. That transition is complete, and there is no scheduled increase. The Social Security resource limit for supplemental security income has not changed. $2,000 for an individual, $3,000 for a couple. There is no fourth stimulus payment, there is no special bonus check, and there is no new benefit being paid to seniors that requires you to sign up through a website you have never heard of. Every one of those is currently circulating, and every one of them is false. And your benefits are not being cut next year. The projected reduction from the trust fund is in the next decade, not next January, and nothing about that changes anybody's check in the year we are talking about. So here is where I come out on all 9, and you may see this differently. What strikes me looking at the list is not any single item. It is that 8 of the 9 were produced by formulas or by laws already passed, and only one of them, the enrollment window, is a place where you get to make a decision. That is the actual shape of this. Nearly everything on this calendar is happening to you. One thing on it is available to you. And people spend the autumn worrying about the parts that are arithmetic, which cannot be changed by anybody, and letting the 8-week window go by, which can change what they pay for an entire year. I understand why. The arithmetic is the part that gets announced. The window is the part that arrives in an envelope that looks like junk. On Medicaid changes specifically, I am not going to give you a political position, because the argument about whether a work expectation is appropriate is a genuine disagreement, and it is not mine to settle for you. What I will say is narrower, and I think it holds regardless of where you sit. Whatever the rule is meant to do, a rule administered through notices, portals, and documentation deadlines will remove people who complied but reported it wrongly. And the states already running it show that clearly. That is not an argument against the policy. It is an argument for making absolutely certain that anybody you love in that category has a current address on file. So, 9 dates and what to do about each one. The 14th of October, the adjustment is announced. Write it down and do not multiply yet. In November, the Part B premium is announced. Subtract that increase, then multiply. That is your real number. The 15th of October through the 7th of December is the enrollment window. Find your annual notice of change, check your drugs, your doctor, your out-of-pocket maximum, and your hospital day rate, and ring your state's free counseling service in October before they fill up. On the 1st of January, the drug cap rises to $2,400. If that matters to you, apply for extra help now rather than in the spring. The taxable maximum and the earnings limits both rise. If you are working while claiming, remember that withheld money comes back to you at full retirement age, and remember the monthly test in your first year. The Medicaid work requirement, the 6-month renewals, and the shortened retroactive window all begin on the 1st of January. Update the address, the phone, and the email with the state agency this month, and tell whoever is affected to open that mail the day it arrives. And if there is a defaulted student loan anywhere in your household, look into rehabilitation now, before an offset starts, because 9 affordable payments ends it. Delphia planned her winter around a number that was never going to reach her account. Clovis turned down a year of work he wanted because of one sentence that was not true. And Reba spent 11 years afraid of a drawer over something that 9 payments would have ended at any point in those 11 years. Every one of those 3 was careful their whole lives. They were simply working from a picture that was slightly wrong in a way that cost them something real. So spend one morning with the calendar instead. 9 dates, 4 of them before Christmas. Most of this list you cannot change, and that is genuinely fine, because knowing which parts those are is what frees you to spend your attention on the one part you can. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.